Got our good buddy Carl Spackler.
Right.
Yep. Writes in again. Andi, thanks for getting my question to Big Al. I guess I goofed in my example because I didn't take into account that capital gains don't apply for married couples with income under $83,000. So with that being understood, I'd like to resubmit the same question with a different income situation. This is called taking advantage.
I think we already answered this, but we'll do it again. It's okay.
I plan on retiring in 6 years with about $1.5 million in IRAs, 1 million traditional, 500,000 in Roth. What I wouldn't need to touch for 10 years. Hopefully it'll be 3 million by the time I need it. During those 10 years, I'll be living off about $1 million that I have in a brokerage account. I have zero income other than the investment income that would be generated. However, I also want to be converting the non-Roth IRAs over those 10 years. I will be fairly young in retirement, 55, so I can spread those conversions out longer than 10 years if needed. However, I like the idea of finishing all my Roth conversions within the 10-year time span because I plan on taking my Social Security at age 65, and I really like the idea of not having to pay taxes on my Social Security. Am I overvaluing tax savings on Social Security by rushing the conversion? Let's assume my $1 million creates $40,000 a year in capital gains. Could you spitball what my options are? For example, perhaps 83,000 max to avoid capital gains, plus 26 standard deduction would give me about 109 of room, assuming $40,000 in capital gain. That leaves $69,000 for conversion. Is my most favorable option. Again, just spitballing. Thanks, Carl. Spackler. That's the old Caddyshack.
That's right. Yeah.
Florida. P.S. My next door neighbor is Frieda's boss. Small world. Frieda's boss.
So got a movie buff here.
Yeah.
Apparently.
He likes the old ones. He loves Chevy Chase.
Yeah.
He must have loved Chevy Chase and Billy Miller. Or Billy Miller. Yeah, that's a
Bill Murray.
Bill Murray, not Billy Miller.
Who's Billy Miller?
That's close.
Billy Miller. Billy Miller is a portfolio manager.
Oh, of course.
Yes.
Everyone
Just
does
right
that.
up there with Bill Murray.
Yeah. Well, no, Miller. He beat the S&P 500 for like, I don't know, 30 some odd years. Now he's completely washed up, blew up.
It doesn't last, does it?
It doesn't. It doesn't. But it's a good ride.
Yeah.
I guess
Right.
Well,
Well,
if
you
you're
have
on
it. Right.
Okay. So to answer your question the same exact way as we did last time is just avoid the capital gains.
Yeah. So here's how it works. So roughly $83,000 is the top of the 12% bracket for married couples. Now that's taxable income, right? Taxable income. And the standard deduction is about $26,000. So you just add that to the 83. So in other words, you can produce about $109,000 of income and of all sources of income and stay in that 12% bracket. If you're in the 12% bracket, your capital gains are tax-free. So let's just say in your example, $40,000 of capital gains, they're in the 12% bracket, they're tax-free. That's a great deal. So that means then, let's see, what's the math here? 69,000. So 40 plus $69,000 conversion gets you to $109,000 of gross income. You subtract the standard deduction, you're at $83,000. Then you're in the 12% bracket. You will pay 12% tax on the Roth conversions of 69, but the capital gains are 100% tax-free. Love it. Absolutely love it. It absolutely works. Now, for some reason, now I'm going to spitball.
Okay.
That's, first of all, that was fact, what I just said.
Mm-hmm.
Spitballing is, if you really want to get this done in 10 years, why not do a giant one this year when the market's down? So yeah, if you do a bigger one, you're going to be in the 22 or even 24% bracket, but you can probably, instead of 69,000, you can probably get almost 300,000 converted and stay in the 24% bracket. And it's like, well, yeah, you paid an extra 10% or 12%, but the market's down 20, right? So if you think about it that way, if you're going to supercharge this, you want to do it while the market's lower.
Yeah, I like it. Or if he, gosh, I got this tickle in my throat. 89,000, that will get the whole thing out in 10 years. And that would keep him in the 12% tax bracket. And then he would be in the 0% tax bracket for life.
Yeah.
Because but Carl, what you got to consider here too is that everything doesn't necessarily have to be out, because how Social Security's tax is based on provisional income.
Correct.
And so what provisional income is that you take a look at your AGI and then add back half of your Social Security, right? And then as long as you can keep that under roughly $40,000, you're still going to be tax-free.
Right.
If he's married, right?
Yeah, but it's going to be hard to do that if, in fact, he's got $40,000 of investment income.
True.
Right, because you're already there.
But
So,
he needs to tax manage the non-qualified account, and but he's going to burn through that because he's going to live off of that $1 million. Plus, some of that is going to have to pay for tax. Along the way. So everything is going to come from Social Security and a Roth.
Right. I would tend to agree with that.
So-
And maybe that's what he's saying.
So he might not have to convert it all, is what I'm saying.
Right. So as the numbers you provided, you can convert 69,000. Now, if you tax manage this better and had about a 2% dividend instead of 4%, now you have 20,000 of income instead of 40. Now you can convert $89,000. And then you go back to what you were saying, Joe, is you can get this pretty much converted in 10 years, except as this thing grows, right? It's going to get away from you a little bit.
Right. So, but yeah, I mean, I think if you really want to nail this thing down, I would probably run some numbers. But he's got the right idea.
Yeah, for
Yeah.
sure.
Are you prepared for retirement? Schedule a free financial assessment with an experienced financial professional right online at purefinancial.com.